Today we will talk about something that will save you money and will help you to decide which health insurance to purchase. Health savings account, or also called HSA. This video is for self-employed individuals who are looking for the health insurance on the marketplace or outside of marketplace, and also individuals who work as an employee, however, their employer does not provide health insurance. We will talk about different numbers, specific numbers. What would be the tax savings if you have HSA or you don't, and whether it's worth it actually to have HSA, even though you are buying a more expensive health insurance. But before we'll go into the numbers, let's talk about the terms. If you know such terms as HSA, deductible, out of pocket, feel free to switch to other calculation. I will have all the time codes below. But if you are not sure about what is HSA and what are the eligibility requirements for HSA, please stay with me and let's look into the terms. Knowing the terms about health savings accounts are important because you need to understand whether your health plan, is actually make you eligible to make an HSA contribution during the year. So what is the health savings account? It is actually a trust account, a savings account. Most of the time it actually accumulates some interest that saves the funds or contains the funds that you can use for unreimbursed qualified medical expenses. Now, qualified medical expenses are considered the expenses that are allowed by the IRS as a medical expenses. And I will leave a link below under the video to the publication from the IRS that explains what the medical expenses are, again, for that tax purposes. So the health savings account has several benefits. First of all, its contributions are tax-free. That means that whatever amount you contribute into HSA during the year, it reduces gross income of the individual or the family, and thus it decreases the taxable income. Next is that whatever interest accumulates on the funds in HSA is tax exempt. Thus, you do not pay any taxes on the interest that grows on the funds that you haven't used and that still remain in HSA. You also can do withdrawals for tax-free as long as the withdrawals are actually used for their qualified medical expenses. So you are not going to be fined and you do not pay any taxes on the amount that you withdraw. Again, as long as you use that amount on qualified medical expenses. There is also a fourth benefit, is that HSA actually belongs to individual. That means that if, for instance, you have HSA during your employment, but then you are leaving the job, you actually can take that HSA and roll over into the HSA of another employer or your own if you decided to go on your own. Moreover, any funds that do not expire, that were not used during the year, will be rolled over into the next year and actually until your death, pretty much. So you have tax-free money that you can use for medical expenses during your lifetime, and the interest is tax-free. Now, the biggest limitation of the HSA is that HSA you are eligible for HSA contribution if you have high-deductible health plan. And we will talk about what is high-deductible health plan. There are specific requirements, but what is important to note is that when we're talking about HSA eligibility, that means that whether you can make a contribution into HSA during the year. So remember, you can make a contribution into HSA or open an HSA account if during the year you have a high deductible health plan. If, for instance, you do not have high deductible health plan during the year, but you have HSA funds, you still can use the funds during the year. You just cannot increase your tax benefit by making a contribution into HSA. So let's talk about what is the high deductible plan, because it's very, very important. So high deductible health plan is the plan that actually has several requirements, and those requirements are related first to deductible. So this plan should have the deductible that is above a specific minimum of deductible. What's deductible? Deductible is that amount that you will cover for medical expenses out of pocket before health insurance will kick in any type of the payments. That's deductible. For 2026, the annual deductible that will make you eligible for HSA contribution, it's $1,700 for individuals and $3,400 for families. The next requirement is out-of-pocket maximum. Out-of-pocket, so the plan actually should establish the out-of-pocket that does not exceed the out-of-pocket maximum for that specific year. So first of all, out-of-pocket is that amount that you have to pay in for medical expenses until the insurance actually will begin paying 100% of your medical expenses. Every year has a maximum for out-of-pocket. So in order to have the your plan, high deductible health plan, that plan actually should have a deductible for 2026 not more than $8,500 for individuals and not more than $17,000 for families. Now, what I need to note that out of pocket, there are two different out of pocket maximums. There is an out of pocket maximum for the plans under Marketplace. Those out-of-pocket maximums are different for out-of-pocket maximum for health savings account eligibility. And we will talk about it now. Why it's important to note is because prior to 2026, or I would say July 4th, 2025, when we've got big, beautiful bill passed, the eligibility for HSA actually applied to all the plans regardless of where you buy it on the Marketplace or you buy it outside of Marketplace. You would have to look specifically at the limitations for HSA in order to understand whether that plan is eligible for HSA contribution. All right? But now there is an exception, and there is a little bit of confusion about it, and I will be honest with you, even I had a little bit of confusion as to how that exception applies. So basically, what the big beautiful bill stated is that beginning January 1st, 2026, any bronze and catastrophic plan will make you eligible for HSA. But here's a note: if that plan actually purchased from Marketplace. Now, how that made me true is that basically if you have a bronze or catastrophic plan, it becomes a high deductible health plan. And according to their House of Representatives vote, when they vote for big, beautiful bill, that bronze and catastrophic plan will become high deductible health plan regardless of whether it meets other HSA qualified high deductible health plan, and those amounts are those that we just talked, deductible and out of pocket. So I actually made this this table for you, so to make it a little bit clearer. So let's just go over it. If you purchase a plan on the exchange or Marketplace, same thing. And this is a bronze plan, or I forgot to add here on a slide, it's also catastrophic plan. Regardless of its deductible out of pocket, that plan is going to be HSA eligible. Meaning if you have that plan, it's considered to be high deductible health plan, and you can contribute money into the HSA during that year. If you buy a plan other than bronze plan on the exchange, meaning silver, gold, and platinum, you need to make sure that that plan actually makes you eligible for HSA, meaning minimum deductible, you look for individuals and families, and maximum out of pocket. If you buy a plan outside of the exchange, it does not matter whether it called bronze it still is going to be under requirement of HSA in order for you to be able to make their in order for you to make an able to make a HSA contribution. So I hope this table will clarify all that confusion about bronze plan, how that works, and why the deductible, the maximum, the minimum does not apply to the bronze plan and catastrophic plan. Again, as long as you're buying on exchange, that's how it works. Now, I just wanted to give you an example. So I think because their big beautiful bill was passed and we do not have much time, it looks like some of the marketplaces and some of the states, definitely in Colorado, they didn't have a time to make an adjustment to the names and to the explanation to the plans. So I will give you an example from a Colorado marketplace, but I'm sure that similar examples you will find in other states that will show how actually the name of the plan does not necessarily state whether or not the plan is eligible for HSA. So here's an example. We have Elevate Health Plans, and it clearly states it's HSA Bronze High-Deductible Health Plan. Okay, makes sense. Let's just compare, just making sure that that's a correct name for the plan. And as we see, deductible for individual is $6,950. Well, it's certainly above the minimum deductible for the plan, $1,700. And also out-of-pocket max is $7,100, which is under the maximum for the HSA eligibility, which is $8,500. Good to go. But even name it tells us what that is eligible. What about this plan, Anthem Bronze Pathway? Well, we know it's bronze, okay, and it is from Marketplace, but you see in the name it doesn't say HSA. However, it's still eligible for their HSA. Why? Because it is a bronze plan that will be purchased from Marketplace. Otherwise, if not for that provision of Big Beautiful Bill, it wouldn't be eligible for HSAs. And here why? Deductible, yes, it's within the limits, meaning it's above of the minimum deduction of $1,700. However, if you look out-of-pocket max for HSA eligibility is actually $8,500. Well, but here the plan is actually $10,600, which is the out-of-pocket max for the marketplace plans. But again, remember, if you buy it, the plan and it's bronze and it's actually purchased from Marketplace, it is eligible for the HSA. So we clarified the terms. Now let's look into their numbers for you to understand why HSA actually will help you to save money and even to save you money to buy a more expensive plan without losing money. All right, now we came to the fun part of this video by actually looking into the real numbers and to see how much money we can save on taxes by opening HSA. For their example, we will take a self-employed person who wants to buy a bronze plan, meaning a plan even though with a high deductible and high out of pocket, but with less premiums. This person more or less healthy, so does not expect many of the medical expenses during the year, and it's more like a catastrophic plan in a way. But we are not buying catastrophic plan. We're buying bronze plan and on Marketplace. That means that we have a plan that is HSA eligible. The question is whether or not it's worth it actually to put any money into a HSA and whether it will help save money. The individual's average tax rate is 15%. And we also, let's assume that HSA account is already open in a bank that gives 3% on average of interest on the funds in HSA. So let's look at the numbers. So again, bronze plan, their premium, let's look at $470 per month. It's actually a real life example. And we have one column where health plan without HSA contribution and health plan with HSA. Again, I will repeat that this plan is high deductible health plan, meaning we know for sure it's HSA eligible. It's purchased from Marketplace. So annual cost for both plans, both options is $5,640. Since we have a self-employed individual, that individual actually can deduct that amount from gross income and thus save money of $846 per year just by the self-employment health insurance deduction. Now, the person who does not contribute into HSA basically has only one type of savings, which is $846 based on the tax savings from the self-employment insurance deduction. However, let's assume that person actually considers to contribute the maximum amount of $4,400 into HSA in 2026. Now, this amount changes from year to year, thus you need to always watch the maximum that you can contribute in HSA. In our case, we assume that the maximum allowable amount actually is contributed into HSA, and it's for 2026, again, $4,400. Well, considering tax savings for HSA, since we have HSA, remember, it's tax-free, it reduces gross income, and thus it reduces taxable income. And in our case, with 15% of average tax rate, we come to the savings of $660. But that's not everything. Also, HSA usually has interest, and it's tax-exempt interest. Thus, whatever in our case, it's $132 in a year. That is tax-free. Okay, tax-exempt, tax-free, same terms. Well, what is the bottom line? If the person who has the health plan with a premium of $470, self-employed, the total savings with the contribution into HSA would be $1,638, which is $792. It's almost $800 more than a person who does not contribute into HSA. So what does it say? It says that even though you spend money, meaning by contribution into HSA of $4,400, you're actually saving money. So think about it. If you saving $792, almost $800, can I just round it up? $800 just by contributing into HSA, you actually can consider that you contribute less than $4,400 into HSA. Right? You contribute about, my math, those tax attorneys, they don't know the math at all. It's $3,600, right? Not $4,400. It's just excellent. And in addition to that $4,400, you actually can spend on their medical expenses. And actually, it's even more because it's $4,532. Just make sure that those expenses are qualified. Now, what about knowing that the HSA can bring some savings to you, right? So what about you actually don't want to buy the cheapest plan? You still want to be within bronze plan, but bronze plans, they're different. Some of them, for instance, they propose you have to require the referral, but some of them don't, and more expensive don't. So you can go to the specialist without referral from your family doctor. Some of them actually give you a smaller deductible, the smaller out of pocket, but you have to pay more in a month. So what about we'll consider the plan, how the plan works if we buy a more expensive plan, but at the same time also contribute money into HSA. And here's an example for you. So in this case, again, remember self-employed individual buying their plan from a marketplace and considers to buying more expensive plan. So rather than paying $470 per month, it would be $520, which is $600 per year difference. It is a significant difference, but will HSA actually help out still save? Well, if you look right away to the bottom of the page, you will see that even with a more expensive plan and with contributing money into HSA, you still save $282. Even accounting for the difference between the premiums. And again, it's all because of all the benefits of the plan is that you contribute money tax-free, which reduces your gross income. You have tax-exempt interest on the funds in HSA. And of course, you can still spend money on the medical expenses. So you see, you have a benefit in this case by having a better health insurance. You have money to spend on medical expenses to cover that deductible. Because I don't know if you remember, but when we looked in one of the examples of the plans, right? The plan is showing, like for instance, this one, Elevate Health Plans HSA. I mean, it is $6,950 deductible. It's a huge amount. So if you have already tax-free money of $4,400, and bless God you don't have it, but you have some issue with your health during the year, you already have tax-free money of actually $4,532 to spend on your medical expenses, and that's to cover that deductible. So the point is that by having the HSA, you saving money, and you save money to the point that you can afford a better health insurance plan. Unfortunately, HSA has their own disadvantages, and we kind of covered them, but let's look into in detail. So first of all, the HSA, in order to be eligible to make a HSA contribution, you should have high deductible health plan. That means that you need to make sure that it's either bronze plan from Marketplace, or you are under the minimum for deductible and maximum for out of pocket. Second, yes, it requires available cash. You actually have to make that tax-free contribution into HSA. For 2026, it's $4,400. So you have to find an available cash that you have to contribute, and you cannot touch it for any other expenses than the medical. So yes, there are limitations. And another one, you need to know the withdrawal rules. So particularly if you are self-employed and you are the trustee of your account. It is very important, because if you make a withdrawal for non-qualified medical expenses, then you actually not only have to include that withdrawal into your income, but also you will have to pay a penalty of 20% in the amount of that withdrawal. Unless you are 65, if you are 65, at least you do not pay the penalty, but you still have to include into income. So HSA is a great tool to save money and thus to afford a better health insurance plan. And, this is life. You always can have some issues with your health, and you'd better be covered. But as you can see, HSA has a lot of benefits. There are few disadvantages, but it's a great tool to save money, to be able to afford the health insurance plan. So if you have any questions, please leave them down in the comments. And I hope you liked that video. I hope it will help you to choose their health insurance plan and actually to decide whether you want to open HSA if you are eligible for that. If you like it, please put a like, subscribe, and share this video with anybody else who are thinking about how to make a decision as to their health insurance plan in 2026. Well, and I hope you will stay informed and strategically wise, and I will see you in our future videos on Olena Knows Taxes.